Preparing for accounting at Deutsche Bahn interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What are the main accounting challenges in a railway group such as Deutsche Bahn? A railway group combines asset-heavy infrastructure with transportation operations, so accounting is especially influenced by capitalization, depreciation, impairment, provisions, and financing. I would also expect complexity from multiple subsidiaries, leases, construction projects, and regulated or publicly supported activities. For Deutsche Bahn, reliable segment reporting and disciplined project accounting are essential because small assumptions about asset lives, utilization, or costs can materially affect earnings, cash flow, and management decisions across the group. While answering, focus on long-lived infrastructure, high capital intensity, regulated activities, multiple operating divisions, complex leases, government relationships, impairment risks, and the need to reconcile operational performance with International Financial Reporting Standards reporting requirements. Question 2. Which accounting framework would Deutsche Bahn use for consolidated reporting? For consolidated financial statements, Deutsche Bahn would generally apply International Financial Reporting Standards as adopted in the European Union, allowing investors to compare the group internationally. Individual German entities may also prepare statutory accounts under HGB for legal, tax, and dividend purposes. I would distinguish those frameworks carefully because recognition, measurement, presentation, and disclosure can differ. In an interview, I would confirm the reporting basis before analyzing a balance, ratio, or accounting judgment. Make sure to cover International Financial Reporting Standards consolidation, the distinction between consolidated and statutory individual accounts, German HGB requirements, group accounting policies, regulatory reporting, and why framework differences matter for analysis and controls. Question 3. How would you account for railway tracks, stations, and other infrastructure assets? I would capitalize infrastructure when expenditure creates a controlled resource capable of generating future benefits and the cost is reliably measurable. Tracks, bridges, stations, signaling systems, and electrical equipment may require component accounting because parts have different useful lives and replacement patterns. Routine maintenance is expensed, while qualifying upgrades are capitalized. Depreciation should reflect consumption, and I would reassess useful lives and test for impairment when technology, utilization, regulation, or physical condition changes. In your answer, talk about recognition criteria, directly attributable costs, componentization, useful lives, depreciation methods, replacement cycles, major inspections, impairment indicators, and the difference between repairs and capital expenditure. Question 4. What is component accounting, and why is it important for Deutsche Bahn? Component accounting separates a significant asset into parts that consume benefits differently. A station, for example, might include structural works, escalators, electrical systems, and signaling equipment, each with distinct useful lives. When a major component is replaced, its remaining carrying amount is derecognized and the new component capitalized. This matters at Deutsche Bahn because infrastructure is large and heterogeneous. Without componentization, depreciation and replacement costs could be recognized in the wrong periods. Be sure to mention separating significant asset components, different useful lives, replacement accounting, depreciation accuracy, materiality, maintenance cycles, and how componentization prevents both overstated assets and distorted operating expenses. Question 5. How would you distinguish capital expenditure from maintenance expense in railway operations? I would ask whether the expenditure merely maintains an asset's existing condition or creates additional future benefits. Routine track repairs, cleaning, and servicing normally flow through operating expense. A major upgrade that increases capacity, extends useful life, improves safety beyond original specifications, or replaces a separately identified component may be capitalized. I would review invoices, engineering evidence, project approvals, and capitalization thresholds to ensure operational teams are not shifting costs into assets. Focus on whether spending creates or enhances future economic benefits, restores versus improves an asset, internal capitalization policies, component replacements, project documentation, approval controls, and the risk of premature capitalization. Question 6. How do you calculate and assess depreciation for Deutsche Bahn's infrastructure? Depreciation allocates an asset's depreciable amount systematically over its useful life, usually using the straight-line method unless usage better reflects consumption. I would assess useful lives, residual values, and component assumptions using engineering data, replacement history, and expected operating conditions. If a signaling system is replaced earlier than planned, that may indicate an estimate change or impairment issue. Depreciation reduces EBIT but not EBITDA, making the distinction important in performance analysis. Cover depreciable amount, useful life, residual value, systematic allocation, component level estimates, usage patterns, review of assumptions, and the impact of depreciation on EBITDA, EBIT, asset values, and investment decisions. Question 7. When would Deutsche Bahn recognize an impairment loss on infrastructure or rolling stock? I would first identify indicators such as declining passenger demand, damaged assets, adverse regulation, technological obsolescence, sustained losses, or project delays. The asset is tested at the appropriate cash-generating unit level when individual cash flows are not separately identifiable. Recoverable amount is the higher of value in use and fair value less costs of disposal. If carrying value exceeds recoverable amount, I recognize impairment and document forecast, discount rate, and sensitivity assumptions. In your answer, discuss impairment indicators, cash-generating units, recoverable amount, value in use, fair value less costs of disposal, forecasting assumptions, discount rates, and reversals where permitted. Question 8. How would you account for rolling stock acquisitions and major overhauls? A newly acquired train would initially be recognized at cost, including purchase price and directly attributable costs necessary to bring it into service. Significant components, such as engines or major overhaul elements, should be depreciated separately when their consumption patterns differ. A qualifying overhaul is capitalized, while the carrying amount of the replaced component is derecognized. Depreciation begins when the train is available for use, not necessarily when passenger service starts. Mention initial recognition, directly attributable costs, componentization, overhaul capitalization, depreciation from available for use date, derecognition of replaced components, and impairment or residual value considerations. Question 9. How does International Financial Reporting Standards 16 affect Deutsche Bahn's accounting for leases? Under International Financial Reporting Standards 16, a lessee generally recognizes a right-of-use asset and lease liability rather than expensing the full rental evenly. The liability is the present value of qualifying lease payments, discounted using the implicit rate or an incremental borrowing rate. The asset is depreciated and the liability unwound through interest. For Deutsche Bahn, property, equipment, offices, and vehicles could be significant, changing EBITDA and leverage compared with pre-International Financial Reporting Standards 16 reporting. Make sure to cover lessee recognition of right-of-use assets and lease liabilities, exemptions, discount rates, variable payments, modifications, renewals, and implications for EBITDA, debt, and cash flow presentation. Question 10. How would you account for government grants or public funding connected with railway infrastructure? I would recognize a government grant only when there is reasonable assurance that Deutsche Bahn will comply with the conditions and receive the funding. An asset-related grant can be presented as deferred income released systematically or deducted from the asset's carrying amount, depending on the applicable policy. Income-related support is matched with the related costs. I would carefully assess milestones, eligible expenditure, repayment clauses, and disclosure because funding conditions can create material liabilities. Discuss reasonable assurance, recognition timing, asset-related versus income-related grants, deferred income or asset cost treatment, performance conditions, clawbacks, presentation, and disclosure of government support. Question 11. How would you account for a long-term construction contract involving rail infrastructure? I would first determine whether the arrangement falls within International Financial Reporting Standards 15 and identify distinct performance obligations. If Deutsche Bahn controls the asset as it is created or has an enforceable right to payment for work completed, revenue may be recognized over time. Progress could use costs incurred relative to total expected costs, provided that measure reflects performance. I would update estimates promptly for claims, delays, change orders, and expected losses, with strong project accounting controls. Focus on International Financial Reporting Standards 15 scope, performance obligations, over time recognition, input or output measures, contract modifications, variable consideration, onerous contracts, estimates, and the need for robust project controls. Question 12. How would you recognize passenger revenue from rail tickets and travel cards? The core performance obligation is transporting the customer, so revenue is generally recognized when the journey or contracted travel service is provided. Cash collected for future journeys or season tickets initially creates a contract liability and is released as service is delivered. I would analyze cancellations, refunds, unused tickets, and travel cards carefully, using historical behavior where appropriate. Revenue should be allocated to the relevant service period rather than recognized simply when cash is received. Be sure to mention identifying the service obligation, recognizing revenue when transport is provided, advance ticket sales, unused tickets, season passes, loyalty programs, refunds, and allocation across journeys or periods. Question 13. What are the key accounting considerations for Deutsche Bahn's freight and logistics activities? For freight and logistics, I would examine when control of the promised service transfers and whether the company acts as principal or agent. Revenue may be recognized over the transportation period, with contract assets or liabilities for timing differences. Fuel surcharges, penalties, volume rebates, and claims require careful variable consideration estimates. I would also connect accounting to route and customer profitability, because operational losses may signal onerous contracts or impairment indicators. Cover service contracts, timing of revenue, variable consideration, principal versus agent judgments, fuel or surcharge mechanisms, contract assets, provisions, segment reporting, and profitability by customer or route. Question 14. How would you account for provisions related to legal claims, accidents, or environmental obligations? I would recognize a provision when a present legal or constructive obligation exists, an outflow is probable, and the amount can be estimated reliably. For accidents, litigation, environmental remediation, or contractual penalties, I would use the best estimate of expected expenditure and discount material long-term amounts. Insurance recoveries are assessed separately and recognized only when sufficiently certain. If probability or measurement is inadequate, disclosure as a contingent liability may be appropriate. Discuss present obligations from past events, probable outflows, reliable estimates, best estimates, discounting, insurance recoveries, contingent liabilities, and ongoing reassessment of provisions. Question 15. How would you analyze working capital in a railway business? I would break working capital into operational drivers rather than rely on one ratio. Advance ticket sales and season passes can create contract liabilities, while corporate customers and public entities may generate receivables. Maintenance accruals, supplier terms, project payments, and government funding timing also matter. I would compare balances with passenger volumes, revenue, procurement activity, and seasonality. A favorable cash movement is not automatically sustainable if it comes from delayed supplier payments. In your answer, cover trade receivables, ticket prepayments, supplier payables, contract liabilities, maintenance accruals, government receivables, seasonality, cash conversion, and operational drivers behind movements. Question 16. What is the difference between EBITDA, EBIT, and operating cash flow for Deutsche Bahn? EBITDA measures operating earnings before depreciation and amortization, while EBIT includes the consumption of long-lived assets. Operating cash flow starts with accounting earnings and adjusts for non-cash items and working capital movements. For Deutsche Bahn, EBITDA can help compare operations before infrastructure depreciation, but it does not fund track renewals or trains. I would therefore analyze EBIT, operating cash flow, capital expenditure, and free cash flow together rather than treat EBITDA as cash earnings. Make sure to explain each metric: depreciation and amortization, working capital effects, capital expenditure, lease impacts, non-generally accepted accounting principles limitations, and why cash generation is critical in an infrastructure-intensive group. Question 17. How would you perform a bank reconciliation for a transport operating entity? I would compare the bank statement balance with the general ledger cash balance, then reconcile outstanding payments, deposits in transit, bank charges, direct debits, and timing differences. Every reconciling item should have evidence, an owner, and an expected clearance date. I would investigate old or unusual items, especially manual journals and unexplained refunds, because they can indicate cutoff errors or fraud. The reconciliation should be independently reviewed and completed promptly after period end. Focus on agreeing bank statements to the ledger, identifying outstanding payments and deposits, investigating unusual items, segregation of duties, cutoff, fraud indicators, documentation, and timely correcting entries. Question 18. What controls are most important in Deutsche Bahn's fixed asset accounting process? Key controls include approved capital budgets, purchase orders, technical completion certificates, capitalization reviews, and reconciliation between project systems, the fixed asset register, and the general ledger. I would require documented useful lives, component structures, and available for use dates. Periodic physical verification helps identify idle, damaged, or disposed assets. Access should be segregated between purchasing, asset creation, approval, and payment. Exception reports for aged projects and unusual manual entries are also valuable. Mention project approval, purchase order controls, asset registers, capitalization review, component records, available for use dates, physical verification, disposals, impairment triggers, and segregation of duties. Question 19. How would you investigate a significant unfavorable variance in railway maintenance costs? I would decompose the variance into volume, price, mix, timing, and accounting classification. For example, higher maintenance costs could reflect severe weather, increased train mileage, supplier inflation, accelerated renewals, or an understated prior period accrual. I would compare actual work orders, invoices, labor hours, and project capitalization to budget and forecast. Then I would determine whether the issue is temporary or structural, update forecasts, and escalate control or operational weaknesses. Be sure to mention decomposing volume, price, mix, timing, capitalization, labor, materials, supplier performance, accrual accuracy, operational causes, and whether the variance is temporary or structural. Question 20. How would you assess whether a rail project is becoming onerous or loss-making? I would compare unavoidable costs of fulfilling the project with the expected economic benefits, using an updated cost to complete model. I would include labor, materials, subcontractors, delay penalties, claims, and probable change order outcomes. If the contract becomes loss-making, the expected loss should be recognized promptly rather than deferred until completion. I would also test related assets for impairment and challenge optimistic assumptions through independent engineering, procurement, and commercial reviews. Cover unavoidable costs, remaining contract revenue, updated cost to complete forecasts, contract modifications, penalties, provisions, impairment, procurement risks, and escalation of project estimates. Question 21. How do foreign exchange movements affect Deutsche Bahn's financial statements? Foreign currency transactions are initially recorded at the transaction date rate, while monetary balances are remeasured at the closing rate, with exchange differences generally affecting profit or loss. Foreign subsidiaries' financial statements are translated into the group presentation currency, with certain translation effects recorded in OCI. I would distinguish transactional from translation exposure and consider hedging relationships. The key is explaining whether volatility reflects real economics, reporting conversion, or ineffective risk management. Discuss transaction exposure, functional and presentation currencies, monetary items, remeasurement, translation of foreign subsidiaries, OCI, hedging, and the difference between accounting volatility and economic exposure. Question 22. What deferred tax issues could arise from Deutsche Bahn's infrastructure investments? Deferred tax arises when the accounting carrying amount of an asset or liability differs from its tax base. Infrastructure may create taxable temporary differences because international financial reporting standards depreciation, capitalization, or impairment differs from tax treatment. Lease accounting and provisions can create deductible differences, while losses require careful assessment before recognizing deferred tax assets. I would use enacted tax rates, consider expected utilization, and document forecasts supporting recoverability rather than recognizing benefits automatically. Focus on temporary differences between accounting carrying values and tax bases, depreciation timing, leases, provisions, tax losses, recognition criteria, enacted tax rates, and the importance of recoverability assessments. Question 23. How would you account for an acquisition or disposal of a business within the transport sector? For an acquisition, I would identify the acquirer, measure consideration and identifiable assets and liabilities at fair value, recognize deferred tax effects, and record goodwill for residual value after considering non-controlling interests. I would separate acquired customer relationships, licenses, and technology from goodwill where identifiable. For a disposal, I would assess whether it is a business, calculate the gain or loss, and consider discontinued operation presentation. Post-close, I would validate opening balances and controls. Mention acquisition date fair values, identifiable intangible assets, goodwill, deferred taxes, non-controlling interests, purchase consideration, disposal classification, discontinued operations, and post-deal integration controls. Question 24. How would you explain Deutsche Bahn's segment reporting to a non-accounting manager? Segment reporting shows how management evaluates distinct businesses, rather than presenting only one consolidated number. For Deutsche Bahn, passenger transport, infrastructure, freight, logistics, and related activities may have different economics and performance measures. I would explain each segment's revenue, operating result, assets, and key drivers, then reconcile those figures to the consolidated statements, including eliminations and central items. This helps managers understand where profitability, investment needs, and operational risks actually originate. In your answer, cover management's view, reportable operating segments, aggregation criteria, revenue and profit measures, intersegment transactions, reconciliation to consolidated figures, and usefulness for accountability. Question 25. If Deutsche Bahn's reported profit improved but free cash flow deteriorated, how would you investigate? I would bridge profit to operating cash flow first, looking for working capital outflows, provision movements, receivables growth, and supplier payment timing. Then I would examine capital expenditure, asset disposals, grants, lease payments, and acquisitions to reconcile free cash flow. Profit may improve because of non-cash gains, lower impairment, or accounting estimates, while cash weakens from infrastructure investment. I would compare the result with budget and prior periods, then test whether the trend is temporary or structural. Focus on non-cash gains, depreciation, working capital, provisions, supplier payments, capital expenditure, grants, disposals, lease payments, reconciliation quality, and whether the deterioration reflects temporary timing or underlying weakness. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.